Philadelphia Fed President Patrick Harker says the central bank is not quite finished raising its target rate as inflation remains stubbornly high. Meanwhile, a fresh report in the Wall Street Journal this morning suggests some Fed officials are signaling unease with big rate rises. So, is this the first sign of the long-awaited pivot? Joining us to discuss is Emily Roland, co-chief investment strategist at John Hancock Investment Management. Emily, I'd be curious to get your thoughts on this report that came out from the Journal today about the debate that's happening and whether you, in fact, think that the data that we have gotten, the latest data, points to the need for at least a pause in the hikes.
Yeah, the volatility in the rates market today has been nothing short of astonishing. You know, we woke up to this continued backup in interest rates that's been playing out over the last few days. And then this, journal article comes out suggesting that potentially the Fed is going to be leaning towards 50 basis points in December instead of 75, or at least discussing that at the November Fed meeting here. So, we think that it's right to consider a pause. And you even heard Lael Brainerd earlier about a week ago talking about the fact that, maybe we are a pause is potentially warranted here as some of the monetary policy decisions start to really work their way into the economy. And it's important to recognize that Fed policy works with long and variable lags. The Fed just started tightening in March of this year, and they've implemented the most aggressive amount of tightening that we've seen in a generation in a really, really short amount of time. We want to watch to see how that actually filters into the economy before the Fed just continues down this path of aggressive tightening.
How much of that have we actually seen filter through the economy based on what you've seen?
Well, we look at the leading economic indicators, and we just saw another negative readings. We've had 3 negative readings in a row here for the leading indicators. And that suggests that we are in a significantly decelerating economic growth climate. The challenge is that the Fed uses, by nature of their mandate, lagging economic data. So they're looking at the fact that the unemployment rate is at 3.5%, near a 50-year low. They're looking at CPI data, which just continues to beat. And a big component of that, of course, is the housing market, shelter, which tends to be a very sticky component of inflation. It takes time to show up in the data. The Fed is marching down this path of dampening inflation really at any cost. But that's the key question, at what cost? And they're looking like they're going to keep going until something breaks.
I mean, the other big challenge, of course, comes down to messaging. And that's been a bit tricky when you think about how things played out over the summer. Now we know that Fed officials didn't feel like the markets were simply getting the message. We got that very strong message at Jackson Hole. Since then, it's sort of been, we're going to continue to hike rates until inflation comes down. How do you think they toe the line here? If, in fact, there is some kind of pause to at least message to the markets, this doesn't mean a pivot. This is just a slowdown.
It's such a great question because the messaging and the forward guidance is so critical. And one of the things we learned from this journal article this morning was that the Fed wants to be careful in avoiding a big upside move in markets based on this perceived Fed pivot. So I think if they do decide to go with 50 in December, it's going to be well telegraphed, whether it's through the Wall Street Journal or some other mechanism. Because, we saw that incredible rally in stocks that played out from mid-June to mid-August, per your point there. And it was based on this false hope that the Fed was going to reverse course in quick fashion. And clearly that's not the case. And they've made it quite clear that they're going to, keep the gloves off in the fight against inflation until the fight is done.
Bottom line, Emily, as we look ahead to the next few months, and what does that mean from an investment standpoint? Does this change at all in terms of your thesis on where things are headed? Or, is this also a time to maybe pause and wait to see where the economic data leads?
Yeah, I mean, investors are feeling really seasick right now as this volatility picks up. And we're suggesting to them that they should focus on the horizon, which to us really means looking at the income on high quality bonds as something that's pretty competitive versus the other alternatives out there. We used to talk about TINA. There's no alternative. And what we meant a couple of years ago, that given the fact that bond yields were so low, there was no other alternative but to buy stocks. And we would argue today that there is no alternative to bonds. yes, price pressures are there, but the fact that you can get 5-6% income on high quality bonds right now, we think is awfully competitive. You look at the dividend yield on the S&P 500, which is less than 2%. So we want to move up the capital structure. We want to get paid income as we wait out this more challenging macro backdrop.